good morning, or afternoon, everyone, depending on where you're located. Welcome to another Webinar Wednesday. For those of you who are new to our webinars, we like to present third-party products for Sage, along with tips, tricks, and tools to better enhance your knowledge and keep you updated on the latest trends. Today's Wednesday's topic is 2021 sales tax changes, which we brought in Travis from Avalara to break down the most notable policy changes and share insight on what the future of sales tax may hold. But before we begin, please note that this webinar is in listen-only mode, and if you have any questions, then please use the chat option, and we will answer them near the end of the presentation. We have a lot to cover today, so I will go ahead and let Travis begin.
Awesome. I appreciate it. Thank you. I appreciate the folks at Acumen for the time today and going over some of the tax changes in 2021 and what we're seeing in the industry, talking to Sage and Sage Intacct users. So I really appreciate it. First and foremost, I'm the director of sales at Avalara. Been here actually just ticked over 8 years at Avalara, and I've done lead generation and working with multiple platforms on tax compliance and working with businesses of all sizes on some of their challenges. One thing that I will say out there that I've talked to multiple companies, I talk to multiple companies every single day, and nobody has a perfect process, and nobody is doing it 100% right. There's so many different challenges depending on the state that you're in or the industry that you're in, whether it's taxable sales, exempt sales, any type of research that you're doing. It's very complex, and a lot of times it's hard to get the right answer. So I manage the team now, and I'm really looking forward to going through some of the changes that we've seen in the industry. All right, so we're going to go through one, what economic nexus means and why it matters. Then try to understand some capabilities of really how your business is impacted based on your transaction history. We'll also get into the different types of nexus, whether it's physical and economic, because that has been probably the biggest change throughout the industry. And obviously the impact of COVID and its influence on 2021, not only from a tax standpoint, but also how the industry is changing, and then as well as new tax obligations resulting from increased marketplace sales. And then we'll dive in a little bit to how to choose the right technology for your business. And then I know that we will most likely have some questions, and I'll provide some answers in that. So I appreciate the time again. One of the things that I want to kick it over is on a poll is just where people out there have the most trouble with tax compliance, whether it's nexus requirements or collecting and managing exemption certificates, filing returns, or just answering customer inquiries or tax research as you're moving in more states. So yeah, the poll is up, and if everyone could select the appropriate answer for their business. All right, so nexus requirements and tax research at about a third, and then the collecting exemption certificates or managing exemption certificates and filing returns. So perfect, I appreciate that. And I'll try to add some tidbits on specifically on tax research and nexus requirements, what we've seen out there. Nexus is what comes up the most in any conversation, and really over the last 18 months, obviously everything's been flipped upside down with one, our life, but two, business, right? And one of the things that as businesses have shut down, sales tax is a key contributor to the state's budget. Obviously being a state-by-state tax and not a federal tax, that's the states are prioritizing really efforts on to try to build their budgets. I think of the states, unfortunately, I mean, as a business, right? They have budgets and they have expenses, and they're trying to increase their budget. And a lot of times it comes from sales tax. And so whether it's, we've seen a heightened stance on sales and use tax audits, and coming from different areas. It might not be directly, but it'd be indirectly that would affect our customers. And then definitely now that we're about, 3 years from the Wayfair decision being finalized, and Florida and Missouri and Kansas have actually been the last 3 states to finalize their economic nexus rulings, which we'll get into. It's really cracking down on economic nexus laws. But obviously, as you've seen out there, there's been a handful of rate increases and jurisdiction increases. So changing things, and I would say on an overall scale, that is probably one of the constant changes, but definitely the change as we get into 2021 is everything is different out there. So from economic nexus to physical nexus to the different jurisdictions and the different rules, it's really hard to keep track of your policy as a business to figure out, all right, how do you tax your items, or how do you collect exemption certificates, or try to figure out if you need to collect in each state. So thinking about economic nexus and what it means and why it matters. So really, like I mentioned, complexity is growing, and it's previously been on a physical presence. So if I guess if I back up, nexus means basically a connection between you and the state. So when I say, hey, I have nexus in North Carolina, where I'm based, my company has an obligation to collect and remit tax in North Carolina. So nexus can be triggered from one of 2 ways. Typically, before the Wayfair decision, it was all on a physical presence. So you needed typically an employee or a location, something of that nature. And now from 2018, on a state-by-state basis, each state has come up with different rules on if you just sell remotely into a state. So typically typically it's $200,000 of sales, or I'm sorry, $100,000 of sales and 200 transactions. And one of the things that we've seen here in not only 2021, but 2020 is when we look at businesses' nexus requirements, and we'll put them through what we call a sales tax risk assessment, but it's basically an analyzation of your nexus requirements. Even 3 years removed from the Wayfair decision, 62% of all nexus triggering events is still from a physical presence. So whether it's a partner program or whether it's some sort of physical connection, that's typically where people are still triggering an obligation. One of the things that we've seen here in 2021 is a lot of businesses triggering an obligation from one side of the business, like a wholesale portion. And then they come to us and say, hey, we're putting an e-commerce shopping cart and we need to collect tax. Well, you've triggered actually an obligation to collect tax through your wholesale division. And now you need to collect tax from maybe a B2C website or something of that nature. So they come to us saying, hey, we need to collect tax, whereas they actually need to register in a lot of these states via the wholesale portion now, and then just collect exemption certificates. And a lot of times people come up and say, whoa, Travis, I don't need to register in a bunch of states because I'm 100% exempt so far. Well, you might not have a big liability by any means because of the wholesale portion, but it's triggered an event where you need to collect exemption certificates and then charge sales tax on maybe a shopping cart or selling to the end user. Thinking about nexus, both economic nexus and physical nexus, the rules are constantly changing, and they're 2 states are never the same. So the rules in North Carolina are different than the rules in South Carolina and the different rules in California and Washington. So they're changing constantly and they're not the same, which obviously increases costs to you because it might not be a hard cost with something that you're paying out, but it might be just human resources and really looking at on a state-by-state basis, do you need to collect there or do you not? And what's the rate and what's the rule? So like I mentioned, 61% of Nexus creating activities are still due to a physical presence. So listed a handful down here. Whenever you travel into a state, whether it's people or property or a location, that's triggered a physical presence. I just talked to someone this morning that said they deliver things into Florida. And so whenever you're using your vehicles to deliver things, then that's going to create a physical presence. There's when I first started at Avalara, there was a story about a mattress company in Portland, Oregon. From you guys on the West Coast, Oregon doesn't have a sales tax. So that company, they thought that they were based in Oregon, them selling and delivering their mattresses into Washington, they didn't need to collect sales tax. Well, lo and behold, they were delivering it on their own trucks and they triggered an obligation to collect and remit in Washington. So that's an example of a physical activity creating a nexus in that state. So it can become, again, the rules are never the same. It could be affiliates, it could be traveling to trade shows, it could be using drop shippers, it could be your inventory, which I have another story about that later today. So physical presence still drives the conversation, even though so many people are focused on the economic thresholds in each state. So yeah, like I mentioned, we have some examples on the side. No two states are pretty much the same. So North Dakota has 100,000 in taxable sales, whereas California and Texas is 500,000 in total sales, both exempt sales and taxable sales, so your total revenue. I have Missouri circled because if any of you guys have been following it closely, Missouri just finalized their law and it goes into effect, I believe, January 1st of 2022. So the Oregon, Montana, Delaware, New Hampshire, those are the states that don't have sales tax. So that's why those are still grayed out. But every other state that has a sales tax has now an economic threshold on a state-by-state basis. I should have also circled Kansas because Kansas actually tried to put in place a law that has all remote sales trigger an obligation to collect and remit. And the reason for these thresholds, so North Dakota is 100,000, California is 500,000. The reason for these thresholds is, and if you agree with it or not, they want to protect quote unquote small businesses. So that's why the thresholds are in place and they have it driven off of typically their economic value. So the big states like California, Texas, New York have a higher threshold, but that's why they've tried to put in place these thresholds on you have to get to a certain threshold on your sales. So Kansas tried to sneak it by and put all remote sales triggers an obligation. However, they've now recently changed it and put in a lower threshold. I believe it's $100,000 in sales. So each state is different. And think of these thresholds as once you've gotten, let's say to North Dakota, once you've gotten to 100,000 in taxable sales, that's where that flag of Nexus goes up. And from that point moving forward, now you need to start collecting and remitting. You have an obligation, just like if you hired a salesperson there. So that's what how these thresholds are taking place. If you have, all of your sales up to that 100,000 in North Dakota, those aren't taxable. You haven't triggered an obligation to collect and remit. So up until 100,000 in sales, Once you've reached that 100,000 in sales, then you've triggered that threshold. A lot of them, a lot of states are in a calendar year, but some are in a rolling 12 months or a rolling 4 quarters, but typically it's some sort of 12-month period. So definitely hard to track, and keep up with just the different state statutes. Oh, poll number 2, getting right out of Nexus and the obligation. Just how confident are you guys that you're registered in the right states? Very confident, uncertain, or not confident? So if you could put up that, there's the poll. We'll leave that open for about 10 seconds. Yeah, I worked with a company that was actually based in Canada, but they were selling throughout the US. They weren't registered anywhere, everything was in Canada. And they just wanted to, they actually utilized Avalara just to track the economic thresholds. So as they got into those in each state, up until the 100,000 or the 500,000, that up until that point, that they didn't have to collect tax. So all of their sales went out with $0 and $0 in tax. But once they just wanted to monitor those thresholds, as they move forward. So perfect. So 63% are very confident. A couple of people are uncertain and not confident. So perfect. I appreciate that. Thank you. That is the last poll. So user participation. I don't think we have a poll 3. It's just 2 polls, right?
Right, 2 polls.
Perfect. So getting into, I need to go down here. Getting into some of the details, if your business is impacted, like I mentioned, that this is truly for only an economic portion. So we have a couple options. If you're just looking for, your revenue and your sales, we have basically a basic assessment that's based on our website. It looks at your total sales volume and matches it up on a state-by-state basis. So really just looks at the overall sales volume and doesn't look at any of the physical requirements. Definitely 2 other ways. You can look at your SALT CPA on the right. Depending on the time frame and the scope, they can definitely help you out as well. We also offer a full assessment that looks at both the physical aspects and takes a look at your economic presence in each state. So yeah, there's 3. So from the far left, looking at your economic presence, you can do that on our website, utilizing us for a sales tax risk assessment, and then looking at a SALT CPA for sure. I can help you out with it. There's a couple different processes. So I've looked at, obviously looking at a state-by-state basis, thinking about if you need to get registered in a state, what are some of the challenges? There are one of the biggest avenues and programs out there that is the SST, Streamlined Sales Tax Organization. And what they do on the SST is about 3 years ago, right around when Wayfair came out, is they were 24 states that have banded together to basically make sales tax collection easier. So it was on a all or nothing basis, but this program now is a state-by-state basis. And for those of you that have triggered a obligation only due to an economic presence, this is actually a great program for you. It basically, you can get registered in the SST for free, and actually Avalara can file your sales tax returns and calculate tax free of charge in these 24 states. So a really great program. If you're taking care of that manually, managing the filing calendar, whether you're typically quarterly or monthly, that all has to do with your tax liability. And then looking at the different platforms. So your marketplace sales, you're from the ERP or maybe a shopping cart, looking at the information from multiple avenues. If you do have any notices from the state, you would have to, whether it's a filing frequency change or a question on your sales tax return, responding to those notices. And really a lot of people, when you're in one state and you've been doing it for 20 years, it's probably pretty straightforward. But as you get different dates and different filing calendars and different sales tax returns, it a lot of times takes down on your resources. And it's maybe not just one person, but it's multiple people throughout the organization that are looking at prep and filing versus higher value projects. I mentioned the streamlined sales tax organization. I have a picture right here of the full member states and the associate member states. And again, if you're triggering an obligation in one of these states only due to economic presence, the SST is an awesome program for you. So it has uniform definitions and rules. There's one registration with one tax identification number, and you get free calculations and free SST or free prep and filing through the SST. And you can file on a one-off, but basically it's a win-win-win all around. So the state is having people register more proactively, and then you are registering more proactively, utilizing like an Avalara or another certified service provider, and then you're filing and remitting more sales tax back to the state. So really good program. One of the things that I know popped up, only I think it was 17% of the folks that we've seen, is looking at the exempt transactions or the exemption certificates. A lot of times I talk to people that come to us for, hey, we're putting on a shopping cart and we need tax collected. However, as we get into this, we look at, all right, well, they might have triggered an obligation in one of these other states, and you need to register in these other states so you can collect tax because you've triggered that obligation. But they, might not collect sales tax exemption certificates or just have them in a filing cabinet. I talk to people every single day that either have them in a filing cabinet, have them in folders, or put them in a box and put it on the top shelf of a warehouse. And I say the top shelf of a warehouse because actually before Avalara, that's where we kept our exemption certificates. I worked at a appliance and hearth distributor. We sold, it was basically 100% exempt sales to independent retailers. And we would collect an exemption certificate when they started an account, and we would put it in a box and we would put it on top of the warehouse. So I've definitely seen it all. And so everyone definitely doesn't have a solid process of renewing that exemption certificate. And we've seen, like the stat says, 43% of audited companies just have a filing cabinet or hard storage for exemption certificates. And what that means for a lot of companies is it's a set it, forget it. They've collected an exemption certificate up front, and they just put it in a filing cabinet, and they have no recourse of updating that exemption certificate. So it's one of the long lost activities to gather those updated exemption certificates. And if you're a state like, I believe it's Arizona, I know Florida has those exemption certificates expire every single year. And so you need to gather a new exemption certificate at the end of the year that's valid for that future year. So that's definitely one of the things that companies run into. So looking at other processes, with Avalaras, what we've seen out there is improving your customer experience. So we have a portal, CertExpress, that actually allows people on the front end to fill out an exemption certificate, so then you can collect it easier. And we've gone away from a compliance portion and a compliance partner to a customer experience portion. And so making it easier on your employees as well as your customers to gather that exemption certificates that, one, meet compliant requirements and utilize resources definitely efficiently. One of the things that, I look at choosing a tax technology, and one of the things that we've run into is these companies that have really challenged Wayfair. And one of my reps on my team had worked with a customer that was challenging the Wayfair decision, challenging economic nexus, and they went by and tracked all of their resources attributed to sales tax compliance. And when you think of a small business, multiple people wear multiple hats. So it's not just one person, collecting the sales tax. It might be a AR person, a controller that, checks the tax returns, up to the CFO to cut the checks. And then obviously like maybe a front end office manager to collect the tax or whatnot. And this company that we worked with, they compiled all of their activities, and it was actually $500,000 of tax resources attributed to that. And I think when I look at this stat from the Aberdeen research, 63 to 193, that to me sounds like a really big number. But when you start to look at tracking nexus, tracking your marketplace sales, tracking use tax, exemption certificate management, tax collection and updating your ERP, there's so many activities that go into this. And then there's a lot of different people affected. So if you have, 3, 4, 5, 6 people affected throughout the organization, maybe an hour here or 15 minutes here, it definitely adds up. And a lot of the people that we talk to think of, hey, even though that we're putting resources at tax management, and even though that we're doing all these activities, an auditor's probably going to still find a mistake, whether it's exemption certificate management or use tax, or just collecting those exemption certificates. So a pretty blown away stat. One of the things too is that we've seen are on the tax audit portion. And I look at this as, the $50,000, that might not be hard costs as they would have to pay, but it's resources attributed to that. And that's what we've seen out there is people applying resources to whether it's the compliance portion or trying to figure out with an auditor in that state. Actually, that's the same woman on our team that worked with a customer that had the 500,000. She worked with another customer that had an audit stemmed from working with Home Depot. Home Depot didn't charge them tax, and Home Depot got hit with an audit in South Carolina, and then that audit triggered an audit for the company that we were working with, just because the state got them on both ends of it. So they weren't self-assessing use tax, and Home Depot didn't charge sales tax. So, and it was how the audit turned up. So 56% of companies have found that the soft costs or the overall cost of a sales tax audit to be over 50K. And one of the, actually in my personal life, I worked with, in my personal life, I knew someone that ran a chiropractic business, and they had worked with their accountant, and their accountant had filed their sales tax returns back to the state, and filed the return for quarterly in 2018 and for quarterly in 2017. But the payments were applied so differently. So they had 3 payments in 2017, 5 payments in 2018 that didn't align with the sales tax returns. And actually, it was right around 50K that she had to pay back to the state because it was past the time frame where she could get it credited back, and just it was payments being applied to the different periods. So definitely not a fun conversation to have. or something fun, a fun activity, but that can definitely happen out there. Before I get into some of the challenges that we've talked about, I definitely wanted to touch on marketplace sales, because that putting on a shopping cart for a distributor or manufacturer or someone who typically sells to exempt customers, or putting their items on, an Amazon or a marketplace, has really affected more the compliance portion. So there's a changes just like economic nexus in the marketplace realm. Whereas if you trigger an obligation in your marketplace and you have multiple users selling to other users utilizing a platform, that marketplace is obligated to collect and remit sales on your behalf. Now, one of the challenges of utilizing marketplaces, if you guys use Amazon or Wix or what have you, you have multiple outlets to be able to apply those sales on your sales tax return. Now, a lot of times, most of the time, you don't have to remit the sales tax because the marketplace is remitting those sales tax. But you have to track that for your sales tax return. So making sure that you're aggregating that data on your sales tax return is a big change from the past. So that's one of the challenges that have come up against, is utilizing multiple marketplaces and trying to consolidate that data on your sales tax return. But thinking about what we just talked about, Nexus and the obligation to collect and remit in each state, whether that's a physical item or an economic item, making sure that you're registered in the right place. That is probably the biggest aspect of tax compliance that we run up against, is companies that are not registered in the right states. So, however you guys do tax compliance, making sure that you're confident that you're registered in the right states, that's probably the most important. Product taxability. So freight is a great example that people run into. Some states tax it, some states don't. Making sure that you have the right information in the system to make sure that you're collecting tax in the right areas. I just ran into this again today in Ohio, is the jurisdictional assignment, and California runs into it. It's really challenging in California, but making sure that you're utilizing the correct jurisdiction. If in Ohio is an origin-based state. So if you're selling from Springfield, Ohio to Cleveland, Ohio, or anywhere else within that one state, you're going to use that origin address for the jurisdiction. If you're selling from Los Angeles to San Francisco, California has a much more challenging jurisdictional assignment, because you're using some of the tax jurisdictions from the origin address, and then also some of the tax jurisdictions from the destination address if you're selling within the state from one part of California into another part of California. So that jurisdictional assignment can be definitely challenging. If you're going from one state to another state, so across the state lines, you're almost always using that destination address. So it's always where the product is consumed, or that ship from, ship to address, so not the build to address. Once you've figured out, all right, I need to collect tax, and you got to figure out if your customer is exempt or if they're not exempt. So that's collecting that exemption certificate and making sure it's on file for the specific state that you're shipping into. So these 4 items are definitely work together. It comes up a lot of times in drop shipping, is you're billing one state, but you're actually shipping into another state, and you're trying to collect an exemption certificate for that home state where you're billing. So making sure that your customer has an exemption certificate on hand for that ship from or the ship to state, to make sure that you are collecting the right exemption certificate. Utilizing the SST, or understanding the filing requirements as you move into each state, just making sure that you're filling out the right forms, you're consolidating the data, and you're filing that on time with the right jurisdictions. And then making sure that you're ready for an audit, you have a documentable, repeatable process, and you're lockstep, so you don't have to be part of the the averages of 50,000 in the case of an audit. So making sure that you're ready for that audit. One of the things with Avalara, we always like to look at this, is understanding not only the calculations and filing the returns, but making sure that you have exemption certificates, your license is up to date. If you sell international for VAT, collecting and remitting that to the state, there was a big law change for those folks that sell into the EU, is if you sell under $150 worth of goods, you have to collect VAT at the time on the order. So under 150,000, or I'm sorry, under $150 or 150 euro in the EU, you would need to collect that at time of purchase. So that's a big change that happened July 1st. And if you sell under $150 or over 150 euro, then there's multiple returns that you'd have to comply with. So that's one of the big changes that's happened in 2021 as well. And one of the really aspects that we've run into are the insights or the tax research. And as you're moving into another state or as you're acquiring businesses, where do you go to for tax research? We have tax research essentials through Avalara, but you can also, we've seen that people have just, gone on Google and looked it up via the state statutes, which can be definitely time consuming. So making sure that you have a CPA that you work with or a business partner, someone that you can get insights into the tax research component. One of the things that pops out from Joe at PACON is not only the sales tax rates, but just the rules. And we go up against, obviously, people compare not only our tax engine, but just the rates that they have in their own system. And even though that every single person that I talk to is very diligent on their sales tax rates and the information up into their system, it's always surprising when they are checking addresses and going through sales tax rates and jurisdictions that they have in their address. So one of the components that we have when we have reps that first start is looking at addresses and going to the state's page and trying to research the sales tax rate for a specific ship from and a ship to. And yeah, it's definitely complex. And one of the things that 8 years ago, when I first started at Avalara, I thought sales tax was super easy. You go to the convenience store, they charge 8.5%, and you're along the way. But now that I've gotten into it, as you're selling into multiple areas in multiple states, is that nothing's the same. Everything's changing. I used to run demonstrations, and I would use the exact same address every single time. 501 Main Street in Half Moon Bay, California. That was the address that we used. And I'd put in the same line items, and week after week, month after month, my order would be $11,000. And I would always be surprised at when the tax jurisdiction for that one address changed either the jurisdictions or the rules. And in the 3 years that I did demonstrations, it changed for that one specific address 5 or 6 times. The special tax jurisdiction went from 2 into 1 and then back into 2. And then they changed the rules in regards to how my shipping and handling was treated. So that's one address, and especially if you're working in multiple jurisdictions and multiple addresses, just keeping your system up to date can be definitely a tall task. So back on the options, thinking about nexus and thinking about economic nexus and physical nexus, just some of the options that are out there. We have a free assessment that looks at your economic presence, but also looking at your SALT CPA or utilizing an Avalara or some other a business to look at your nexus requirements. Like I mentioned, that's probably the number one aspect out there in regards to sales tax is your nexus requirements and where you've triggered an obligation. A lot of times, like we've seen, it hasn't been a tax liability. but you might need to collect exemption certificates from these different states that you might need to register in. So a lot of times it's not like, oh, hey, you need to get registered, you need to pay this big back tax liability. No, a lot of times it's just get registered moving forward, collect exemption certificates from your customers in that state, and then if you need to charge sales tax, whether it's on a shopping cart or to an end user through your ERP, you're set up to do so and then remit that back to the state. Definitely do not want to collect tax on an order and not remit it back to the state. That's a big no-no in the sales tax world. So if you collect the tax, you want to make sure that you remit that and are registered to remit that back to the state on a move forward basis. That is all I have. Do we have any questions in the chat?
So at this time, we'll open up the chat option for you guys to write in and we'll answer out loud. Travis, I did see 1 or 2 questions come in while you were talking, so we can go ahead and get started while people write into the chat. The first question that I saw was, what happens if I've triggered an obligation but don't have too many taxable sales?
What happens if you trigger an obligation or too many taxable sales? I bet that just came in right before I mentioned it about a minute ago. So yeah, a lot of times we see this, right? So you've triggered an obligation, you might have your total sales, and most of them are exempt, and you've triggered an obligation, but you don't have too many taxable sales, right? So a lot of times that comes into just getting registered, and then collecting exemption certificates a lot of times from your customers. So you might not have a high liability or a high taxable liability, but you definitely don't want to, in the case of like an audit or something of that nature, you don't want to not be registered or not collect exemption certificates, because then you're on the hook for that sales tax liability. So those exemption certificates are actually kind of like your reasoning on, hey, why did I not collect tax on this order? It's because I have a valid exemption certificate on hand. Here you go.
Perfect. Thanks, Travis. Looks like there's a few more that came in. It says, does physical presence still factor in post-Wayfair?
Yeah, yes, definitely. A lot of times we see that physical presence still runs the coop, right? So people have triggered an obligation due to some sort of physical requirement in a state, and even though that they haven't triggered a economic activity, they still need to get registered. I just talked to someone today that actually rented their equipment throughout the U.S. And they weren't registered there, and I asked them, all right, well, what happens, if that equipment, disappears or breaks or whatnot? And he says, well, that's our equipment. We have to bring it back and fix it. And so that was a red flag in my mind, because they had their equipment sitting in all these states, very similar to FBA with Amazon selling online. Is you package up a shipment of your goods and send it to these warehouses. So you have an obligation due to a physical presence of your inventory being in these other states. Selling on Amazon's awesome. It boosts revenue in many cases, but also it can be a tax liability. So if you have your inventory sitting in Amazon warehouses and then sell goods to the end user, whether it's directly through your Sage system or Sage Intact or whatnot, or through a shopping cart, you've had your inventory sitting in these warehouses, and now you need to collect tax to end users when you sell that. So something that pops up definitely on the physical presence side.
Thanks, Travis. Another one that came in is, how difficult is automation to implement and set up?
Yeah, that's a good question. So there's 2 sides of the implementation. Speaking directly with Avalara, there's 2 sides of the implementation. There's the IT side, so getting that, we call it a connector, but it's a piece of software that overrides the native tax functionality in your ERP, or a shopping cart, for instance. So we have 700 or 800 different pre-built integrations on the IT side to make it easy on that side. And then it's the second portion is the accounting side. So telling our system where you need to collect tax, mapping any items to our product taxability codes. So if freight is a good example, California might not charge freight, but Washington does. So running invoices and having those taxability codes mapped to your SKUs or your item codes will define the taxability, and then setting up your returns. So all that accounting side that's individual to your business, because you know an Avalara doesn't have to charge tax where Acumen does, right? We have a different footprint on the accounting side. So accounting side is one end, and then the IT side with those pre-built integrations is the other end.
Thanks, Travis. Looks like that's all the questions that came in, so I'll go ahead and wrap up. So thank you all for joining us today. If you have any additional questions, please email us at am@acumenfl.com or give us a call at 407-965-2411. If you haven't yet, make sure to follow us on LinkedIn, Twitter, and Facebook to stay updated on the latest content, and subscribe to our YouTube channel for the latest videos and webinars, which this webinar will be posted on there. Our next webinar would be on next Wednesday on the best practices for backing up your Sage and making sure you are protected against big risks such as cyber attacks. So we hope to see you all there. Thanks again for Avalara for the great presentation, and we hope you all have a great rest of the week.
Awesome, thanks.